Bitcoin is trading just below $93,000 as of December 4, 2025. But beneath the surface, the market is sitting on a powder keg. More than $6 billion in leveraged positions are at risk of liquidation, and the entire direction of this cycle could be decided in the next few days. Today we're breaking down why some of the sharpest minds in crypto are issuing diametrically opposed warnings right now. First, the bearish case, and it's coming straight from the data. CryptoQuant CEO Ki-Young Ju published a stark assessment yesterday. Most Bitcoin on-chain indicators are bearish. Without macro liquidity, we enter a bear cycle. He's referring to weakening signals across the board. The MVRVZ score has rolled over. Network activity is declining. Stablecoin liquidity is contracting, and on-chain profit margins for traders continue to shrink. In simple terms, the fundamental health of Bitcoin's blockchain is flashing red at a time when the price is still within striking distance of all-time highs. Greeks. Live chief researcher Adam Chu reinforced that fragility. In an interview with Decrypt, he stated, cryptocurrencies face strong resistance to upward movement, with market participants still maintaining a bearish mindset, leaving the market highly vulnerable. Now flip the page to the bullish argument, and it's equally compelling. Derivatives data from CoinGlass shows that a move of only about 3 to 4% in either direction would trigger massive liquidations. Roughly $3 billion in short positions would vanish if Bitcoin reaches $96,000 to $97,000, while $3.5 billion in longs would be wiped out on a drop to $89,000. BitGet chief analyst Ryan Lee believes the balance of probability favors the upside. He told Decrypt, "At this stage, a short squeeze looks more likely than a long squeeze. Institutional inflow remains stable, regulatory signals are becoming constructive, and sentiment is gradually shifting towards risk acceptance." Supporting evidence can be seen in declining open interest combined with rising cumulative volume delta in perpetual futures, classic short covering behavior. Spot demand is still quiet, but forced buying from squeezed bears could provide the spark. Sentiment's crowd sentiment model adds a contrarian twist. Retail investors have swung back into extreme greed over the past week, a setup that has reliably preceded corrections in previous cycles. If history is any guide, the crowd being overwhelmingly bullish right now is actually a warning sign for the short term. Macro context cannot be ignored. Markets are pricing in nearly 90% odds of a 25 basis point Fed rate cut next week. A dovish outcome could supply the exact liquidity Ki-Young Ju says is currently missing. So where does this leave us? Bitcoin is caught between deteriorating on-chain fundamentals on one side and an enormous short interest that could ignite a violent squeeze on the other. Institutional accumulation continues at roughly 6 times the rate of new supply issuance, steadily removing liquid coins from circulation. A convincing break and close above $96,000 would likely trigger cascading short liquidations and open the path toward $100,000 and beyond. Failure to overcome that resistance, especially without fresh macro support, risks confirming the prolonged bear cycle that some analysts now fear. The next 7 to 10 days will be critical. We must remain vigilant, monitoring institutional inflows, tracking exchange outflows, and, above all, watching the Federal Reserve's next move. If you found this breakdown useful, please hit the like button and consider subscribing so you don't miss the follow-up when the next major move happens. Thank you for watching, and I'll see you in the next one.